everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show on what is one of the more exciting Mondays we've had in recent memory. Welcome. We are going to jump right in because, needless to say, I think we're all up to speed on the latest developments. We've had some significant consternation here in markets against the back of what looks like credit crisis risk that has been somewhat arrested here, at least for now. The markets seemingly liking the solution that authorities have come up with for the unraveling of Silicon Valley Bank, SVB, also over the weekend Signature Bank in New York, another regional smaller bank taken over by authorities over the weekend, and another one friendly to sort of the tech startup and the crypto space. That space, of course, under significant strain thanks to rising interest rates now for the better part of a year and a half, if not longer. And so we have some shaking in the financial system here in the past several days, last Thursday, Friday, and then, of course, over the weekend, ostensibly, those issues were ring-fenced, and the message from officialdom that these were episodic things and not systemic things, and so we've cut things off and we're ready to move forward. And the market has generally taken that guidance and concluded that indeed these things have been, for the most part, contained. But of course, where this gets really critical is the market's perspective has also included a dramatic downshift in Fed rate hike expectations, ostensibly because the Fed has moved aggressively enough, surely, at this point, and so we have a reason for them to back away, that they're not going to continue to squeeze, and that that thing that needs to snap in the credit structure has snapped, and the Fed can basically put the inflation fight down. This is an interesting thing to come, of course, because tomorrow we are looking at CPI data that's due to cross the wires, and that data might well give us a scenario where the Fed might need to do more, at least if the data is to be looked at in isolation. So what we're going to do here is we're going to have a look at all of the moving parts and see to what extent we might be positioned for a surprise, to what extent the data might be supportive of the Fed continuing to press on with inflation versus to what extent do the markets think they're going to be prepared in light of recent events, and therefore what kind of risk there exists in this number creating some more volatility in markets. So let's take a look at first what is expected and consider it in light of where things are in the economy itself. So consider that what we're looking for is a pullback in inflation down to 6% on the headline CPI number. Consider also, as we have for a few months now on this chart, that realized inflation has tended to lag by about 2 months, 2 to 3, give or take. But we'll look at 2 here as a benchmark behind based expectations. So if you look at where expectations are, that's the yellow bars. That's the break-even rate over a 2-year window. So essentially, that's the bond market saying where it thinks inflation is going to be in 2 years' time. And what you can see is that in February, that number went north of 3%. and now we're at about 2.78, 2.8. So in other words, what the bond market is saying, and the break-even rate is just the inflation adjustment that you need to get from nominal two-year yields in this case to real ones. So you take nominal yields, you subtract from them real yields, and you get that inflation adjustment baked into the bond market that gets you from nominal to inflation adjusted. And that tells you that the bond market is saying the Fed is not hitting its target in 2 years' time, which is a pretty close approximation of the Fed's perception of quote-unquote medium term. The goal, of course, for Fed policy is to get to a 2% inflation rate that's sustainable over the medium term. And while nobody has formally defined what medium term means, the general sort of sense is it's about a 2 to 3 year window. That's something from the RBNZ. They're the only central bank, the Reserve Bank of New Zealand, that's done any sort of published work that I'm aware of that sets out what that is. And so with this in mind, the Fed is off target. And if we get a CPI number that's relatively warmer than expectations, or even just in line and developing as would have been expected, the upshot is that we have a pickup telegraphed in these break-even rates over the coming months. And so the Fed's inflation fight is ostensibly not over. They ostensibly need to do more. That's because the U.S. economy has turned out to be much more robust than expected. If we take a look here at the Citi index of expectations and outcomes relative to expectations here on U.S. economic data, we can see the sea change right there in February. That, of course, begins with the explosive jobs report that we saw at the beginning of that month. We just saw the subsequent jobs report last Friday. It did not have in it significant signs of a collapse in labor markets. The unemployment rate ticked up just a hair. The participation rate did as well. So it's unclear that this increase in unemployment means that more people have left work. On the contrary, it seems to suggest that more people are looking for work and so became counted as unemployed, whereas before they were not counted as such because they weren't looking. So it seems like we have a situation where certainly the jobs number itself, the payrolls number, came in hotter than anticipated. And the upshot seems to be that overall U.S. economic data is significantly better than the markets expected. We're now pushing ever higher, even today, on this index. And so the Fed has more to do. But of course, with the events of the past 48 hours of market action, maybe even the past 52 hours of market action, we have obviously a significant rethink. So the orange line that you see there is the implied Fed rate 12 months forward from any given day. So essentially, on any given day, where is Fed funds in a year's time? You can see that what you get in February with this data getting better as we see it right here is you start to see a pickup in Fed rate hike odds all the way up into that kind of 5.5 area for 1 year forward. And subsequently, you have a decline. And that, of course, what we have been given here over the past several days. So that decline clearly reflecting not just the unraveling of everything that got added into this outlook over the course of February and the first days of March, but essentially takes us all the way back to before things appeared to be stabilizing in the fourth quarter of last year. Now, the difference in this setup versus what we'd seen before. So you can see from about the middle of 2021, the OFR Financial Stress Index, which tells you how tight or loose financial conditions are, it was rising with Fed rate hike odds because the Fed was itself the reason for more tighter conditions. As the Fed was raising rates, stress was rising in markets. You can see that in the fourth quarter of last year, when that orange line flatlines, the stress comes off. That would be the market essentially saying, okay, we think the Fed is done. We think they've reached the point that they need to reach. We think the terminal rate for the Fed is in sight. You can see against that backdrop, you don't get a pickup in the stress index, but it stops falling and essentially begins to idle, looking to see if the markets can digest it. And what we see now is that the two curves have started to move inversely. So you've had a significant pickup here in the stress index, and rate hike odds have fallen off a cliff. With this kind of setup, markets are understandably asking, is the Fed even in a position to keep raising rates? Surely they have to retreat because the tightening that they've done so far has already broken something and guided investors in the direction of significantly slashing these odds of further tightening. You can see that in the shape of the yield curve. So needless to say, we had a much more aggressive yield curve a week ago, looking for rates to peak out somewhere around 5.5 to 5.75, and looking to do that in somewhere between July and September. What we're looking at, even back to the beginning of February, was more aggressive than where we are now. And again, the peak there, somewhere between July and September, a little bit shallower of a peak at about 5. What we're looking at now, essentially, is one more rate hike coming in perhaps in a month's time. So maybe next week, maybe in May. Perhaps a bit of a hold over a 3-month window, and then cuts. And significant cuts at that. So if we look at the full breakdown, we are at this point fully baked in for one more hike, somewhere almost fully, I should say, baked in for one more hike between now and May. So you can see that come May, the implied rate delta is about 20 basis points. So we're just about 5 basis points shy of having a cut fully baked in. For next week, the March 22nd meeting, you can see it's about a toss-up, about a 56% chance that we get a hike, and then about a 22% chance that we get a hike in May. So between the two of them, what we're looking at is about a 78% chance that we're going to get a hike somewhere before June. And then looking at then what happens in June, you can see we're essentially looking for a flat outcome relative to now. So you can see in the implied rate delta column, we're lower than 5 meager basis points, essentially, then versus now. In other words, the Fed is expected to fully reverse whatever it does by that point. And from there, you can see the cuts begin. So we're fully baked in for an almost 50 basis point cut by July. That cut is already there in September, and we are looking at a 75 basis point cut equivalent by the end of the year. If we assume that we are actually going to get this hike that's going to happen on current market expectations, or at least is more likely than not to happen on current market expectations between now and May, then we're essentially looking at a net 50 basis point cut between now and the end of the year, which clearly is a dramatic shift in the market's thinking. And you can see that here. So these are expectations for May and expectations for June. You can see May is where the peak is seen at this point, and from there, lower. So a really, really dramatic rethink of what the Fed is going to do here. But is this an overreaction, you might ask? And there is some evidence that it might be. Now, of course, we do have the number tomorrow. We will see how markets read it. We will see what the response will be. But it is worthwhile at this stage to look at whether the Fed is really going to move forward with fully abandoning everything it's been saying as though the inflation problem were solved. Let's consider what's happened so far. This is a chart looking at total global trade volume relative to measures of U.S. inflation. You can see they've topped at the same time. The global trade volume data is up to November, so it's a little bit lagged. The IMF is not the source of the timeliest of data. They take their time to release things, and the total global trade volume numbers are from them. But you can see here very clearly that the peak in inflation and the subsequent pullback largely coincides with the peak in global trade volume. So what the Fed has done here is essentially slowed economic activity. They've discouraged economic activity from continuing to be explosively buoyant. And they've done this, as you can see here, on a global scale. This, of course, makes sense because what the Fed is doing when it raises borrowing costs in the U.S. is make the global reserve currency, the medium of exchange for global commerce, more expensive to borrow. And so what they've done is they've made the cost of global economic activity face a higher hurdle rate. So not surprisingly, this has cooled economic activity, cooled goods demand, essentially. Because what you see here is a generalized stalling of the post-COVID run-up in global volumes, which very clearly would tell you, okay, it makes sense that inflation is coming off, growth is coming off. And that's what the Fed ostensibly has been saying for months, and it's exactly what they were hoping to achieve. But what that's done is it's taken us to an inflation rate of about 5 or 6%, depending on whether you look at PCE or CPI. Not the 2% that the Fed wants to achieve. And as we just saw at the top of the show here, break-even rates would suggest that the U.S. economy is hot enough that they've not done enough to get us to 2%. And this is likely why. What you're seeing here is the difference between labor supply and labor demand in the U.S. The red line there is labor demand. So that's the total number of people currently employed. And added into it is the current number of job openings available. So that's how much labor the U.S. economy wants to have. essentially. That's the number of people that are either doing work or the number of available places for people to be doing work. And then the blue line is the U.S. labor force itself. So in other words, the supply of available labor. Importantly, I'm not even looking at those people already in work here. I'm looking at the entirety of the labor force, which means people either in work or looking. So this blue line actually includes the unemployed, defined as people without a job that want one. And so you can see we've opened up a substantial gap here. So during COVID, you can see the number of people wanting to work was substantially outstripping demand because obviously everything was closed, businesses were shuttered, the global economy was on lockdown. What you see here now is for various demographic reasons, namely the accelerated retirement of baby boomers that were already on the way to retirement. You could see narrowly leading into COVID, the red line was above the blue one. So you were already getting a sense that demand was starting to outstrip supply as those baby boomers were retiring. We talked about this on the show before. The 55 and over contingent in the labor force currently, still the largest contingent at 24%, but also the one with the lowest participation rate at about 38-40, as opposed to close to 80% for the others. And that's because those people are approaching retirement. And what COVID did is accelerate that significantly. Where people that were maybe a year away or 2 years away or 3 years away said, you know what, everything's on lockdown, I'm done. I've retired now. And so what we're left with currently then is a significant labor shortage. And that, of course, means that businesses have to compete for that labor on the only measure that's available, on price. And the price of labor is wages. So what you see here then is when you take that spread between supply and demand and you map it over inflation, you can see that the structural reasons for inflation haven't gone away at all. As a matter of fact, over the course of the past several months, they've ostensibly strengthened a bit. And not surprisingly, a buoyant U.S. economy that's creating more pressure here is part of the issue. So you can see that, again, through COVID, the gray bars there show you that there is a significant outstripping of labor supply as relative to demand. And then, of course, it begins to aggressively decline with the reopening of the economy. And as that happens, you can see inflation start to surge. And already as of the middle of 2021, you start to see a build where demand starts to significantly outstrip supply. And that's not an issue that's gone away, nor is it an issue that's likely to go away, because you can't just invent more workers unless you were to have some sort of a dramatic policy breakthrough on immigration. But even if you did, that doesn't suggest that you can necessarily import the right skill set. It doesn't necessarily suggest that you can deploy those people with the right skill set into the right areas of the economy. And so the pressure on wages remains. This is nothing to say further about deglobalization, which continues to bid up costs. But of course, with the Fed slowing the goods side of the equation already, obviously that's what we saw here, that's maybe a little bit less of a concern. we seem to have reached something like a peak in global volumes, but deglobalization has not been the reason why we've probably topped out here. It's been more probably the Fed's actions. So maybe that's more of a longer term concern that we'll come back to over time. But this is very much still here. And so from the Fed's perspective, their job's not done, most likely. But they have to balance that against the stability risks that have now emerged. So if we were to get a hot CPI number in light of all of this, and the Fed were to then signal that they're throwing in the towel, there would be issues on the inflation side of things. That would be a tremendous risk for the economy. Because if then that means that inflation is going to run unchecked, and that's the message that the markets walk away from the Fed announcement having, then you're looking at a much weaker dollar. You're looking at the erosion of purchasing power. Consumption is, of course, still the largest component of U.S. growth. And then perhaps you're looking at elevated recession risk. If, on the other hand, the Fed wants to send the message that indeed these bank failures at SVB and Signature were episodic as opposed to systemic, and that they've now been contained not with monetary policy, but with specific targeted, what are called macroprudential measures, well, then they can continue to work against what this is, which is a longer-term structural inflation issue. Now, that probably doesn't mean that the Fed is going to rush to scream at markets that they've shaved off too much of rate hike expectations. Surely they're not attempting to capsize the boat here. But it may be that the level of consternation now in markets, the level of markdown in rate hike expectations, is now asymmetrically extended in the other direction, the lower direction, the dovish direction, having been extended in the hawkish direction, and both are ostensibly not quite right. So it could be that what we end up with ultimately is a hot CPI number that might get markets to think, wait a second. For the Fed to back off here would be perhaps engendering a crisis in confidence, given that inflation isn't solved, and would suggest that the Fed sees larger issues, especially given that inflation isn't solved. And so, would it be a bad message here for the Fed to back off? Would it signal that there's a greater issue than the Fed wants to communicate? And might that be counterproductive then? If that were the case, then we might see some very brisk reversals of the kind of moves that we saw today. A backing off from bonds, a shift back up in yields, a shift back up in the US dollar, a shift down in gold, and perhaps the most vulnerable of all, a shift in stocks. Because whether it's imminent bank stress or credit stress, or a Fed that's not quite prepared to throw in the towel on rate hikes, equities have found very little to like about this current environment. And may continue to going forward, if this kind of push and pull and this kind of uncertainty continues, even just in the near term. And that is macro money for this very exciting Monday, March the 13th of 2023. I have been Ilya Spivak, head of Global Macro here at tastylive. Thank you very much for joining me. I am here 4 days a week, Monday through Thursday, just after overtime with friend of the show, Chris Vecchio, head of Futures and Forex here at tastylive. I'm also on First Call with Tom and Tony on Sundays, and with Chris for Futures Power Hour on Fridays. Outside of those shows, you can catch me on Twitter opining. That's at Ilya Spivak. Thanks very much for joining. Good luck out there, everybody. Godspeed. Talk to you tomorrow.